Hi everyone, and welcome to today's video. If you've ever wondered how to invest wisely with less risk, you might have heard about something called index funds. Today, we're going to break down what index funds are, how they work, and why they might be a great option for both new and experienced investors. We'll cover everything you need to know to get started, from the basics right up to how you can start investing in them. Stay tuned to find out why index funds have become a favorite among investors looking for an effective way to grow their money. Let's jump right in. Let's start with the basics. What exactly is an index fund? An index fund is a type of mutual fund or exchange-traded fund, ETF, designed to follow or track the components of a market index, such as the S&P 500, the NASDAQ, or the Dow Jones Industrial Average. The idea is simple. Instead of picking individual stocks and trying to beat the market, an index fund tries to mirror the performance of a specific index. This means if the index goes up, so does the value of your index fund, and vice versa. The fund achieves this by holding all or representative samples of the stocks or bonds within the index it tracks. Why does this matter? Index funds are built on the principle that over time the market will generally increase in value. By mirroring the market rather than trying to outsmart it, index funds offer a cost-effective way to invest in a broad section of the market without the need to micromanage individual stock picks. This approach has proven to be highly effective for many investors because it offers broad market exposure, low operating expenses, and lower portfolio turnover. If you're looking for a way to invest that is straightforward and doesn't require a lot of time to manage, index funds might be just what you need. Index funds have a fascinating history that dates back to the early 1970s. The very first index fund was launched for institutional investors in 1971, but it was the introduction of the first index fund available to individual investors by Vanguard in 1976 that truly revolutionized the investing world. This fund was based on the S&P 500, aiming to give investors a way to buy into the broad market with a single investment. Since then, the popularity of index funds has soared, especially over the last few decades. Why? Because more and more investors are recognizing the benefits of these funds, mainly their simplicity, cost efficiency, and effectiveness in capturing market returns over the long term. Today, trillions of dollars are invested in index funds worldwide. They've become a staple in retirement accounts and are frequently recommended by financial advisors for building diversified portfolios. Whether you're a beginner or an experienced investor, the chances are high that index funds are part of your investment landscape. Investing in index funds is straightforward, but there are a few steps you should follow to get started. First, you'll need to choose a brokerage account if you don't already have one. There are many online platforms where you can open an account quickly and often with no minimum investment. Once your account is set up, the next step is to select which index fund you want to invest in. There are numerous index funds out there, each tracking different indices. For instance, if you believe the technology sector will perform well, you might choose an index fund that tracks the NASDAQ. Alternatively, if you want a broad exposure to the largest companies in the US, you might opt for one that tracks the S&P 500. After selecting your index fund, you decide how much money you want to invest. You can start with a relatively small amount of money, as many index funds allow for fractional share purchasing. This means you don't need to buy a whole share but can own a part of a share corresponding to your investment amount. Finally, you place your order through your brokerage platform. You can typically choose between a lump sum investment or setting up regular contributions to gradually build your investment over time. This approach, known as dollar cost averaging, can help reduce the impact of volatility by spreading out your investment purchases. Remember, while investing in index funds is relatively simple, it's important to do your research or consult with a financial advisor to ensure that the funds you select align with your overall investment goals and risk tolerance. Now that you know how to invest in index funds, let's talk about why so many investors choose them as a core part of their investment strategy. There are several key benefits to consider. First, diversification. By investing in an index fund, you're purchasing a slice of the entire index it tracks. This means you're automatically diversified across many stocks or bonds, reducing your risk if any single company underperforms. For example, an S&P 500 index fund spreads your investment across 500 of the largest U.S. companies. Second, cost effectiveness. Index funds are known for their low expense ratios. That's the annual fee you pay as a percentage of your investment. Since index funds are passively managed, meaning there's no team of analysts continually researching and picking stocks, the management costs are significantly lower than those of actively managed funds. Third, transparency. With an index fund, you always know exactly what's in the fund because it mirrors the composition of its benchmark index. This visibility is a major plus for investors who prefer to know where their money is going. Fourth, performance consistency. Historically, index funds have often outperformed actively managed funds over the long term. While they are designed to match the performance of the index rather than beat it, the lower fees of index funds mean that more of your investment goes towards growing your money rather than covering costs. Finally, simplicity. Index funds offer a straightforward way to participate in the potential growth of the stock and bond markets. They're an excellent choice for those who prefer a set-it-and-forget-it approach to investing, allowing you to spend less time monitoring and adjusting your investments. These benefits make index funds an appealing option for anyone looking to build wealth over time without the hassle of picking individual stocks or paying high management fees. Now let's compare index funds with other popular investment options, like mutual funds and ETFs, to help you understand when you might choose one over the others. First, let's look at mutual funds. The primary difference between typical mutual funds and index funds is the management style. Most mutual funds are actively managed, which means that a fund manager makes decisions about which stocks to buy or sell in an attempt to outperform the market. This active management usually comes with higher fees, which can eat into your returns over time. Index funds, by contrast, are passively managed, as they automatically track a specific index, leading to lower fees. Next, let's consider ETFs, or exchange-traded funds. ETFs are similar to index funds in that they can track an index, but they trade like stocks throughout the day on an exchange. This means you can buy and sell ETFs at any time during the trading day at market prices. Index funds, however, are only priced at the end of the trading day. ETFs might also have lower minimum investments and could be more tax efficient due to how they are structured and managed. Now, looking at individual stocks. Investing in individual stocks allows for potentially higher returns if you pick the right stocks. However, it also comes with higher risk and requires more time and knowledge to manage effectively. Unlike index funds, which provide instant diversification, buying individual stocks can expose you to significant financial risk if your choices do not perform well. Finally, let's touch on bonds and bond funds. While index funds typically focus on stocks, there are also bond index funds. These can be a good option if you're looking for more stability and less risk than stock investments. Bond funds follow indices that track various types of bonds, offering a diversified bond portfolio in a single investment, similar to stock index funds. In summary, the choice between these investment options should be based on your financial goals, risk tolerance, investment timeline, and the amount of active involvement you want in managing your investments. Index funds offer a mix of ease, cost efficiency, and reliable market performance, making them an excellent choice for many investors. While index funds offer numerous benefits, as with any investment, there are also risks and considerations to keep in mind. First, market risk. Index funds are subject to the same ups and downs as the market they track. This means if the overall market declines, so will your index fund investment. It's important to remember that while the market generally trends upwards over the long term, there can be significant short-term volatility. Second, lack of flexibility. Because index funds are designed to track an index, managers of these funds don't have the discretion to make changes based on market conditions. This means you won't benefit from potentially savvy decisions that active managers might make in an attempt to beat the market. Third, specific index risks. Each index fund tracks a specific index, and the composition of that index can carry specific risks. For instance, an index heavily weighted in technology stocks like the Nasdaq may be more volatile than more diversified indices. Fourth, tracking error. This is a risk where the index fund does not perfectly match the performance of the index it tracks. This can happen due to a variety of factors, including fund expenses, timing of dividend reinvestment, and the method used to replicate the index. Lastly, dilution. Because they are designed to diversify, index funds spread your investment across many assets. While this reduces risk, it can also dilute the impact of high-performing stocks on your overall portfolio performance. To manage these risks, it's vital to maintain a diversified portfolio that aligns with your long-term financial goals and risk tolerance. Consider speaking with a financial advisor to tailor an investment strategy that suits your needs. As we've discussed the workings and benefits of index funds, it might be inspiring to hear about some real-life success stories that highlight the potential of this investment approach. First, consider the story of John. John started investing in an S&P 500 index fund 20 years ago with just a small monthly contribution from his salary. Over the years, he continued to invest consistently, regardless of market fluctuations. Thanks to the power of compounding and the overall growth of the market, his initial modest investments have grown significantly, providing him with a substantial nest egg for retirement. Next, there's the example of Emma. Emma is a freelance graphic designer who didn't have a corporate retirement plan. She decided to open an IRA and started investing in a total stock market index fund. Over the last 10 years, she has seen her investments grow steadily, demonstrating how index funds can be a reliable part of a self-made retirement plan, even for those without a traditional income structure. Lastly, let's talk about a community project. In a small town, a group of teachers came together to start an investment club where they pooled their resources to invest in various index funds. This collective approach allowed them to learn about the stock market and see firsthand how diversified investments could lead to stable growth over time, even with initial low contributions from each member. These stories show that whether you're a solo investor starting with little money, a professional looking to supplement a retirement plan, or a group interested in learning about the market together, index funds can offer a straightforward, cost-effective path to financial growth. Remember, the key is consistency and patience. Index funds are a long-term investment strategy. As we wrap up our discussion on index funds, I hope you now have a clearer understanding of what they are, how they work, and the various benefits they can offer to investors like you. We've covered the essentials, from the basics of investing in index funds to understanding their advantages over other investment options, as well as considering some real-life success stories. Investing in index funds is a proven strategy for those who are looking for a low-cost, effective way to grow their wealth over time without the hassle of picking individual stocks. It's suitable for beginners and experienced investors alike, providing a straightforward path to achieving financial goals. If you found this video helpful, please give it a thumbs up and share it with friends or family who might also benefit from understanding how index funds work. Don't forget to subscribe to our channel for more financial tips and investment strategies. Your engagement helps us create content that assists you in making informed financial decisions. And if you have any questions about index funds or investing in general, leave a comment below. I love hearing from you and will do my best to answer your queries. Remember, your financial journey is unique, and taking the time to learn about your options is a crucial step toward success. Thanks for watching, and see you in the next video.